We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Grant Williams. He's the publisher of the newsletter Things That Make You Go and the host of the Grant Williams podcast. Thanks for joining me today, Grant.
Hey, Tom. It's a great pleasure. How are you?
I'm excellent. How are you?
Good, man. Not too bad at all. Not too bad at all. The world is an interesting place right now.
Well, that seems as usual to be the understatement of maybe the decade, but I'm very, very humbled by having you join me. I know you've been an expert in this field for a long time, and I look up to you in many ways because you do an excellent job on your podcast, and you get to speak to many of the smartest people in the room.
Well, that's very kind of you. I'm by no means an expert. I'm trying to figure this whole thing out along with you and everybody else right now. You know, which is precisely why I have those conversations, because I'm trying to learn, and if other people can kind of sit on my shoulder as I try and learn, then that's I think that's got to be helpful. So that's really what this whole thing's been about for me, just trying to figure it all out. So no, expert, no, curious, inquisitor, maybe.
Well, that's actually where I kind of wanted to start. You know, you and I speak to so many different people, and as I said, many of the, let's say, the smartest people in the room. And I want to ask you how you're able to, let's say, parse things out and really end up maybe falling into one camp or the other. If we take, for example, the recession in the US as let's say, a case that we want to debate, there seems to be two camps, really. One says that we're already in recession. The other one that says the data simply doesn't support that because of maybe the labor market conditions. So how do you try to make sense of both sides of the argument and, kind of come to a conclusion for yourself?
Well, I think the first thing to understand is, any conclusion that you may be able to come to is, to quote the Fed, transitory, right? It has to be. Any conclusions you have, you have to be willing to change. And I think that's the big mistake people make, is they fall into it's a recession camp. And at that point, they shut down any argument that it isn't. And they go into every conversation about it, defending that hill and trying to convince the other person who says it isn't a recession why they're wrong. And let's take a step back. Why are we trying to figure out whether we're in a recession or not? Well, the answer is because we want to know what we ought to do if we are in a recession. How should we invest? How should we trade? So if you think about it from that standpoint, every other trade, every other investment you make, you have to be willing to be wrong. You have to be willing to be wrong and change your mind as soon as you realize you're wrong. And so the barriers we put up to being convinced we're wrong are sometimes way too high. And so we stick to our position because we don't like to be, no one likes to be wrong. And unfortunately, in a world of social media, people are very belligerent and very public about their claims. There's a lot of people out there in places like Twitter who will make, very dogmatic statements to a big audience. And you can watch as the data changes, you can watch them trying to find a way to walk that back, but realizing, wow, I've been so forceful about this. I can't just say I was wrong. Yes, you can, right? Because at the very beginning, I've said this so many times, we're all just trying to make guesses about an unknowable future. So being wrong, it's a coin toss. So I think for me, it's a case of listening to people whose not just whose opinions you value, but whose process you value and you understand and you put value on, but always be willing to say, okay, well, that's what this group of people think. Now, do I agree with them? And it's quite frightening sometimes to disagree with them, but it's important because you have to trust yourself at some point. And this is one of the reasons why I've through my days at Real Vision and beyond, I've always been I'm very wary about giving quote unquote actionable advice, right? Because ultimately we're all responsible for our own trades. And I think when you start giving out quote unquote actionable advice, you open a can of worms that you take the lid off and you don't know what happens to it after that. People take on that trade thinking, oh, he's a smart guy. He said I should buy Apple shares. But they don't have the inputs that you have. They don't know how you're evaluating the news flow after that, whether your positions change, whether your mindsets change, whether you're structural or tactical. People don't know. And so you have all these kind of orphan positions out there of people that took the advice of the smart guy on the TV. Whereas if you can help people understand how to make those decisions themselves, then that that actionable advice becomes an input, not an instruction. And you can say, wow, smart guy saying I should buy Apple shares. Do I agree with that? Right. Mm-hmm. That's the first thing you'll always have to make. And I think that's, for any of us that have a platform, to me, that's the best thing we can do is not to give people ideas, but to help people create their own ideas. Because if you can do that, if you can refine your process and you can understand not just who you want to listen to, and there'll be different people for different topics, so you need a broad net, but how to use the information they give you to be able to act independently, then that's, to me, that's the whole ballgame.
Yeah, I absolutely agree. And it seems kind of what you're getting at is you want to help people kind of build that framework to be able to understand all of those inputs so that they can question or point out where they might think somebody might be right or wrong.
Yeah, absolutely. You have to stress test everybody else's ideas the same way you have to stress test your own. And so being able to do that at the start rather than, blindly follow someone's advice, and then once you have the position and something happens that goes against you, for example, then suddenly you have to get up to speed and understand, crikey, what do I do now? Mm-hmm. That's it's a tough thing to learn on the fly. Whereas if you go into something knowing, okay, look, Jim Cramer's the perfect example, right? Jim Cramer's the perfect example. He's out there spouting nonsense and giving recommendations to the masses every day. Mm-hmm. And look at the smart money. The smart money has launched an inverse Cramer ETF, right? But sadly for a lot of people, there are people who just follow his advice because he's the guy on the TV and he makes a lot of noise and there's a big, there's a lot of fireworks around it, and that's enough for some people. And I watch stuff like that, and it saddens me greatly. It's fine in a market that only goes one way, and fortunately we've had that for some time. But we're entering what I suspect will be the most difficult markets to navigate of any of our lifetimes. Mm-hmm. And so I think trying to unlearn this reliance on other people and learn self-reliance through creating your own process and listening to how smart people trade, not what they're buying and selling, is going to be much more valuable going forward.
Mm-hmm. Well, exactly on that point, Grant, that is an excellent theme that I kind of picked up on from some of your recent work, is the idea that we have to unlearn basically the idea that, or unlearn what the market has taught us from decades of easy monetary policy, and the way that this credit cycle is completely changing everything. So maybe we can start with where you think the largest risks in this new investing world lie for the global markets.
Yeah, no, I again, coming back to the topic we've just discussed, I think that the biggest impediment we have is in our own heads. As you've just alluded to, we've had 40 plus years of conditions that have become very familiar, and we've all grown up and cut our teeth in that world that works a certain way. When there's stress in the system, the central banks come in, they lower interest rates, it works. We reached the end of that and lowering interest rates didn't work, so they start buying bonds, and that worked. But either one of those has ended up with the same outcome, which has resulted in this Tina mentality and FOMO and buy the dip and all these cute little phrases that everyone's become used to. And I suspect that's all gone away. I don't think it's gone away completely, because we'll probably still get one more look at that in action. Mm-hmm. But we're getting closer and closer to the end where that doesn't work. And that's why the the emergence of inflation as a real threat is so important for people to understand. That was always the thing that was going to stop the central banks doing what they've done for the last 40 years, right? Because all the time they've done this, lowering rates, taking them negative, QE, all these things, the other side of that coin was inflation. Mm-hmm. And when we went into, if you remember after 2008, when they launched the TARP and they went into QE, everybody, including me, was worried about inflation. And we were worried about the wrong kind of inflation. We were worried about CPI inflation. And of course, we didn't get it. What we got was rampant, and I mean rampant, asset price inflation. But that doesn't show up in the weekly checkbook balances of the average citizen. So it quote unquote didn't matter. Mm-hmm. Now it is here, and now it does matter. And we always knew that when that came, it was going to stop the central banks being able to use the policies they've used thus far. Now, unfortunately, in the period between them starting this, these policies of negative interest rates and QE to today, the buildup of debt in the system has been absolutely astronomical. And so the quantum of them not being able to do this is such that they will be forced into incredibly drastic measures just to keep things together. It'll be financial repression, it'll be yield curve control, it'll be capital controls, currency controls, all these things, all these enemies of free markets that we've talked about and read about, if for those of us that have read history and worried about over these years, are likely all going to come home to roost at the same time, not through choice, and it never was going to be through choice, but through necessity. Mm-hmm. And that's kind of where we are now. We're at that point where you've seen the Bank of England go from QT to QE in one day, mm-hmm. because the system got out of whack, and the LDI situation in London caused them to have to do that. And inflation is a 180 from deflation, and so I've talked about this before, but the simplest way to think about the changes that we're going to go through is, if you look at deflation being the driving force of everything we've seen for the last 40 years, it's been a deflationary environment with lower highs and lower lows on interest rates and on bond yields. Then inflation coming along turns all that on its head. You need to get used to higher lows and higher highs in interest rates in bond yields, and you need to get used to lower highs and lower lows in stock markets. That's just the natural order of things, but that's a natural order that central banks and policymakers will do everything they can to reverse, and they'll have some degree of success for a while. But when they start to lose that game, they won't simply fold their tents and say, okay, all right, we tap out. They will start to do things that, don't fit within free market economics, that aren't things that many people thought would ever happen. And look, if you want a recent example, go back to the bail-ins in Cyprus, right? Mm-hmm. That was something that no one really thought was possible. But hey, guess what? You wake up in Cyprus and you've lost 20% of your savings if you had a certain amount of money in there. Nothing you can do about it. And very quietly, that bail-in got written into law in the EU. So that's coming for everybody now, and I don't think anybody really realizes it. So we're approaching a very dangerous part of the cycle now, and I think people need to be aware of that first of all, to realize that even though we're in the middle of a bear market rally and it looks like stocks are going up, and they may go higher, things have changed. And with that change comes a need to learn how to do things in a very different way to what's worked for the last 40 years.
Mm-hmm. So, you bring up the UK Guild example, and this seems to be a real symptom of major cracks starting to appear in the financial system. Do you think that the confidence has been restored for now? And maybe what parts of that situation do you think that the average person really doesn't understand, the nuance of that situation that is important to understand?
Well, look, I think for the average person in the street that doesn't really follow financial markets deeply, the simple explanation is something happened that is under the surface and could have been a huge problem. It's been fixed for the time being, but what you will see, again, under the surface, are an awful lot of pension funds who didn't get caught up in that, particular situation, going through their holdings, going through their structures, and realizing, okay, we are at risk of being caught up in that. If the same thing, LDIs is not exclusive to the UK, right? There's plenty of them in the US and all across Europe. There's some massive LDI positions across the pension funds of Europe. So right now, as fiduciaries, those companies are going through their holdings, and in this little calm period where the storm has died down, it's not a case of, phew, that was close, on we go. It's a case of, wow, look what could have happened to us. Here's how we could have been caught up in that. Now let's take steps to mitigate that. So the ripples from that are going to keep going outwards. That, the stone's in the pond now, and the ripples are going to keep going outwards. So even though you don't see it on the surface, that action is being taken underneath by any smart fiduciary. And we're talking pension funds. These aren't hedge funds that can be a little bit more cavalier with some of their decision making. These are enormous state pension funds and the kind of companies that are very conservative by nature and have been forced into these instruments, these structures, because of their inability to earn yield the old-fashioned way, by buying bonds that match their liabilities. So it's one example of how the world's changed, both in what happened, in how quickly it happened, in what it made central banks do. There are all kinds of lessons there for people paying attention. And I think Mark Rubenstein put out a tweet thread yesterday talking about how his firm had been buying the LDI linkers that were being sold off at vastly reduced prices. It was a massive fire sale because people were forced to sell those things, and they had capital. And they realized that these are good instruments. They're just being sold because they're forced sales. They're not considered sales. So there will be people that are waiting for this kind of thing to happen. And at the moment, there were enough people looking to soak that stuff up. But if we get another big dislocation, and it's not just a few UK pension funds doing this, then the sellers will overwhelm the pool of smart capital that's been waiting for the chance to buy them, and it will once again end up on government balance sheets because that's the only place to go.
Mm-hmm. Yeah, it was interesting. One of your recent conversations, you guys were talking about that fact that there are markets that have finally gotten to a level that people have been waiting maybe a decade or more to be able to buy some of this stuff, and they're finally getting the opportunity, which is in some ways mind-blowing, because the intelligence of being able to sit and wait for a price level that you really want, while also, let's say, having the brass to enter a market that is seemingly very risky at that point. It's an incredible situation that has presented itself, right?
Well, let's go back to what we talked about at the top of the show. Let's go back to that idea of actionable trade ideas and being able to do your own work, right? And we'll take Mark Rubenstein as the perfect example. Here's someone who's done his own work. Mm-hmm. He knows what the value of things are. He knows what distressed prices look like in that asset. And he doesn't need, to them, it wasn't a courageous decision to step in and buy these. It was an opportunity. They didn't need courage to do it because they knew exactly what they were doing. They knew what they were waiting for. Mm-hmm. They knew what these things were worth, and they had cash. That's it. So if you're in that position, none of this stuff is complicated. However, now let's put ourselves in the mind of someone who was told by a smart guy on the TV, hey, you should buy linkers in the UK. We think they're a great trade. Well, here's a guy who's holding on to these things. The guy on the TV is not on his speed dial. There's chaos in the market. Everyone else is selling them. He's got this thing that he was told was a great buy, and now it's turning out to be caught up in the thing. What does he do? He doesn't know. So he probably sells it along with everyone else because he's afraid it's going to go to zero. So that's the benefit of knowing the instruments you trade in, understanding your own process, and having dry powder. Right, this idea of dry powder is such an important one, particularly now. And I had a conversation with my friend Felix Zulauf yesterday. And we were talking about this, about cash and the importance of holding cash as an asset. And Felix said, and he's written to his clients recently, that holding cash is a phenomenal thing to do at periods in time. And not just if you're in the investment business and you're being paid on performance, you tend to think, I have to be fully invested at all times because I'm not going to earn any return on cash.
Mm-hmm.
And so you're not free to make smart decisions. But as an individual investor, as someone that doesn't have investors to satisfy, LPs to satisfy, you can just do the smart thing at any given time if you're smart enough and patient enough and you understand what you're doing well enough. And sometimes that might be, hell, being in 100% cash. That might be the smart thing. And you could say, well, that'd be ridiculous. Well, if you'd have been 100% cash on the 16th of September 2008, you had an absolute field day.
Mm-hmm.
It doesn't mean you have to be in 100% cash forever, but the idea that holding cash, particularly in a time of negative real rates like we're seeing now, a lot of people just dismiss that as a terrible idea, and we couldn't possibly do that. But look, if you can pick things up down 50%, that pays for an awful lot of years of earning negative 2% on your cash. So it all feeds back into this idea of the time for just being able to follow what people say blindly and taking that on trust and being told when to buy and being told when to sell. Those days, I think, for the foreseeable future are gone, and you need to now really start to understand what you're doing with your money.
Mm-hmm. Yeah, I think an important idea that I try to really help people with a lot of the time is to really manage their emotions around trades. It's important, I think, again, the idea of having a framework, understanding what you think something is worth, and as you say, having the dry powder to be able to capitalize on that when the opportunity does present itself. Maybe a better or a fresher example for most people would be the COVID lows of 2020. Having dry powder in that situation and being able to recognize that situation for what it was, with the banks not necessarily completely reversing course, but not fighting the Fed in a lot of cases. That really is a perfect example of being able to understand from an objective standpoint what that situation was, right?
Well, let's talk about emotions. You mentioned the word emotions there, which is, of course, a critical part of all this. But if you think about the way emotion affects us in finance and investing and trading, the emotion comes from the unknown. It comes from unexpected things happening. It comes from markets reacting in ways you didn't expect. It comes from companies missing guidance. It comes from the unexpected. And this is why it's so important to have a plan, to sit down and think about, whenever you have $1 invested in anything, whether it's a stock or a bond or currency, whatever it may be, having a plan for the what ifs. And if you can understand what you'll do in a bunch of different scenarios, and there's no way, of course, you can correctly predict all of the possibilities that might happen. But there are horses of a different color, right? There are bad outcomes and there are good outcomes, and you can kind of think about likely handicapping the potential good outcomes and similarly the bad outcomes, and then have a plan. At least you're not completely caught cold when something goes against you, and understanding if X happens, I'm out. If Y happens, I'm doubling up. Whatever it may be, taking the time to think about that stuff and have a plan for certain events, you find that the emotions at periods like those March 2020 lows. Now, COVID came out of the clear blue sky,
Mm-hmm.
but if you had holdings in your book that you were happy with and you wanted to add to if they came down, and you had other stocks or whatever it was that you've held on the way up, and you're thinking, wow, these are getting toppy, I should sell them. When they all acted in a certain way, you probably knew, I'm going to sell the ones that are falling, and I'm going to use that cash to buy the ones that I wanted to add to lower down. But when you've just got a whole bunch of positions and you're cheering the market on every day going up because you're into this position, you can't even remember why you bought them, but you read somewhere or someone told you somewhere to buy them, the emotions will overtake you because there's so much uncertainty around it, and we hate uncertainty as human beings. So we'll do what we can to kill the uncertainty, and that generally is turfing out the position.
Mm-hmm. And I think another part of that psychology that's really important is that the piece of recency bias, right? always think that things are going to continue. And that, again, goes back to that lesson that we have to unlearn basically what the market has taught all of us over the past, really for 40 years, right?
Well, that's right. And I think it's such a great point to make, Tom, because, recency bias we think of as a week, a month, a year, maybe. And you can unlearn that kind of recency bias in a hurry when things go against you for a period of time. But when you're trying to unlearn an entire career, that's much, much harder to do. And many people won't be capable of it until it's too late. And this is why reading and understanding financial history is so important, because all the stuff that's happening has happened before somewhere in history. We've seen it all. And so understanding not just how markets reacted, but how people reacted to these things will help you handicap the potential outcomes. It will help you understand the potential severity of moves in either direction. And it will give you an edge over the people that blindly just follow the herd and will follow them right over the cliff.
Mm-hmm. Grant, I'd like to move a little bit to one of the other recent examples that I think is really important to understand, and that's how the Bank of Japan had to really defend its peg and overtly intervene in the markets to avoid further declines during this time. So do you think it's possible that the Bank of Japan really starts to lose confidence, or let's say the rest of the world starts to lose confidence in the BOJ's ability to continue to provide stability at this point?
Look, I think outside Japan, confidence was lost in the Bank of Japan a long time ago. The Bank of Japan has been a running joke in the financial community for the longest time with what they've done. Whether it's their being a top 10 holder in just about every stock, every ETF in the country, or whether it's owning over half the JGB market, or whether it's the fact they've created a JGB market that goes entire days without trading, or whether it's the negative interest rates or the cap on it. It doesn't matter. There's a list of things that the BOJ has done that make them a joke in financial communities. Now, they've been successful, and I put that in inverted commas, to this point, if you measure success as the entire thing not imploding. They've been successful. They've had, I don't know how many lost decades now in the country. They've got a demographic nightmare ahead of them. And finally, because interest rates are going up and inflation is now back in Japan as well, which is a huge problem for them, I think people can see the rubber meeting the road for the Bank of Japan. And so whereas before nobody bothered to take them on because it didn't really seem to be much point, you can see in what's happened with the yen recently that there is now a point. There is money to be made taking the other side of the Bank of Japan. And if you think how skewed their position is and how skewed it's made their currency and bond markets, there's a lot of money to be made being on the other side of the Bank of Japan if things return to normal. So you're seeing this, if you look at this 25 basis point peg on the 10-year JGB, and you look at swaptions on the currency, you can see that peg is expected to break and go from 25 basis points to 50. And that's a cautious price, because that's where the markets are willing to do it. They're obviously underpricing it. I think there's upside from there. So you've seen in the bond markets, people are starting to take significant bets that they'll fail. In the currency markets, we've seen two what would have been significant interventions by the Bank of Japan in the last month or 2 months, both get turned right around. And the yen continue to power down, even though the number goes up because it's inverse to the dollar. So the Bank of Japan has for the longest time been the canary in the coal mine, and the answer to, can this nonsense that the central bank's doing work? Well, and people say, well, it's worked in Japan. Works until it doesn't. And, if we're reaching the point where Japan is going to have to abandon either its bond market or its currency, it's going to be a very interesting choice that they make. We're seeing already that they're more willing to let the currency slide. I suspect in the hope that the dollar starts to weaken, and so it naturally takes some pressure off them. But with another 75 basis point hike yesterday from Jay Powell and co., and some 95% tough talk. There was one line in the release that gave the Dove some hope, but pretty tough talk from the Fed. I don't see the dollar necessarily stopping anytime soon, which is going to create more headaches for the Bank of Japan. Today we've seen the Bank of England come out with a 75 basis point hike, their biggest since 1989, I think. And you've got the bizarre position of the Monetary Policy Committee, the Bank of England, in their release, saying that we don't think peak interest rates are as high as the market's priced them. So they've raised 75 basis points, and the pound has fallen 2% today, which is a big fall, because they're trying to desperately convince the market things aren't as bad as the market thinks they are, and the market's saying, yeah, they are. And you're behind the curve, you're behind the Fed. There are plenty of other places we can put our money, and suddenly your balance sheet is beginning to matter to us, which is what we saw when the quasi-Kwarteng budget was such a flop. There was a couple of $1 billion to a country that's got an 8% current account deficit. There was a couple of $1 billion thrown in, and that was enough to drop the sterling almost to parity with the dollar. So at some point, as my friend Dave Dredger likes to say, that the last grain of sand goes on the sand pile and disturbs the equilibrium, and everything falls. And we're that close to one of those things happening in so many places right now. It's almost impossible to keep count.
Absolutely. And, it makes me wonder how, considering both of those countries import so much, let's say, and really how much energy they both need to import, how big of a role that let's say the current energy crisis and prices could be really playing into that situation, and in some ways really be a nail in the coffin for both of those countries.
Yeah, it's huge. Look, there's only one country in the world, right, that can print its own currency to buy oil, and that's the United States. So it's no coincidence that the dollar's doing what it's doing. It's also no coincidence that we're seeing the Chinese desperately trying to find a way to buy yuan buy oil in yuan. And recent reports suggest that there may be a deal been done with Saudi that they can do that. They talked about doing that with Russia, because this energy problem, it won't go away. Energy is the basic building block of life, and so without energy, you're toast. So people need to find a solution to that problem. And we've seen the UK price caps put in, which, given the extent of this energy crisis and how long it may go on for, could be absolutely disastrous. And once you put those caps in place, you're left with, okay, do we blow our budget by continuing them, or do we back down and become incredibly unpopular because we've walked back promises we made? It's a lose-lose situation. Mm-hmm. So the energy situation is incredibly important. It's going to drive an awful lot of the moves you see in currencies, in bond markets, and most importantly, in election cycles, and in kind of social dynamic between governments and the people who voted them in, because it's a basic need, right? You need energy, and you need food, and you need shelter, and the cost of all three is rapidly becoming unaffordable.
So, Grant, from your perspective, how important are some of these shifts, let's say, of the Saudis, for example, making those cuts and adjustments to OPEC, China moving towards buying energy for yen? Could they be the beginning of, in some ways, monetary history for switching away from the US dollar and really providing, in a lot of ways, a new framework for the entire world to trade?
Yeah, absolutely. I mean, that's exactly what this is an attempt to build. There's no two ways about it. How long it will take, how successful it will be, is unknown at this point. But the OPEC move was interesting. In times gone by, if the American president had called the Saudis and said, right, we need you to hike production, it would have gotten done. For them to not only not do what they were asked, but to go the other way and cut production, tells you a lot about what you need to know about the relationship between the US and the Saudis, and who the Saudis think going forward are going to be the more important partners to them. And that's likely to be the Russians and the Chinese. And so this parallel system to the US dollar has been slowly constructed in plain sight for a long time now. And my friend Luke Groman, who writes research called Forest for the Trees, has been on this longer than everybody. He's the guy who first awakened me to it a decade ago. And it's if you're paying attention, you can see this framework being built. You can see the bilateral agreements being signed. You can see the moves being made by central banks to divest themselves of dollar assets. You can see all of it happening, but only if you're willing to believe it's a possibility. And for, again, going back to what we talked about at the top of the show, for a lot of people, the kind of change we're seeing now is too big to contemplate. People rely on what they've learned so far and go, well, that could never happen. There won't be a world where we don't pay dollars for oil. Well, there was, right? There was in 1930, there was. There just wasn't that much oil. And now it's become even more important for these countries to be able to import oil in their own currency so they can print the currency to bring it in. And on the part of the exporters, to find reliable partners who they can transact with some degree of confidence and with a mutual understanding. And I think the move that the United States Treasury made in confiscating Russian central bank assets was a catastrophic overstepping, a hugely important error they've made that has put every country on earth on alert that, hey, if we piss the United States off, and look, today it's because we're crossing a border into someone else's country, who knows what it might be tomorrow? You're siding with another country against the United States in a diplomatic standoff. You just don't know. But they've proven that when the circumstances dictate, they can be an unreliable partner. And so if you are a central bank anywhere in the world now that needs to hold dollar reserves to pay for energy, you are looking at those reserves and saying, is there a way we don't need to hold so many dollar reserves so that we're not hostage to any kind of capriciousness on the part of the United States Treasury because of what? Who knows? So that's going to be a huge help for this parallel framework being built. There'll be more people interested in being a part of it now, even if they think, well, maybe we just want to buy half our oil in dollars. So why don't we just pay for half of it in local currency and half in dollars? Now the US is going to fight kicking and screaming to stop that happening because, every dollar that someone doesn't need to hold to buy energy reserves is a dollar less of treasury sales that the US can make to fund record deficits. So this whole thing is wrapped up. And it's getting to the pointy end now, which is why we're seeing war. The war didn't start because of the United States Treasury. I'm not saying that for a second, but everything is now getting tight and tense because we've reached the kind of end of the financial bungee cord that we've been plummeting off for the last 40, 50 years, and it's going to snap back. And if you're not ready for that snapback, you're going to get whiplash. And I think that's what we're seeing breaking out all over the place.
Yeah, there's so many different pieces to that conflict, that puzzle that we need to understand. You bring up the idea that really in a lot of ways Russia was just trying to defend and enforce a line that they had already basically set in the sand to NATO and to the rest of the world. And I think a really important point to really understand is that the world can't really live without Russia's energy, right? The non-elasticity of the oil market is really important. And the idea that we're going into possibly a global recession, which was cited as one of the reasons that OPEC made that 2 million barrel a day cut, on top of the fact that they haven't been meeting their quotas, kind of comes back to the idea of emotions, right? There's so many times where people point out, well, the Saudis did that to spite Biden and really show the US who has the power, instead of looking at it as more of an objective move, because they don't want to be, as you said, caught flat-footed, being overproducing into a market that doesn't or that is very likely to be not consuming as much oil coming into this next phase.
Yeah, but it just, again, it speaks to the shift in priorities of the Saudis. They are now okay to go against the United States, not just not give them what they want, but actively go in the opposite direction to further their own interests, to make sure their own interests are protected. And that speaks to this reverse of globalization and this kind of splitting up of a world that had become ever more interconnected. And when times of stress arise, it's always domestic politics that trump international politics. Always. It's just always been that way. But we've had this tailwind of falling rates and easy and easier credit as this globalization wave has swept the world. Now things are starting to get tight, and understandably so. People worry about their own people and the safety and the health of their own countries, and act accordingly. That's what the United States has done. They're not being anybody's friend right now. If you look at what they're doing to get inflation under control domestically, you can see what that's doing to the dollar, and you can see the ripple effects that's having right around the world. But I haven't heard Jay Powell or anybody else at the Fed pay any lip service to the damage the dollar's doing. Not once have they said, well, we've realized what trouble the dollar's causing around the world, so we're not going to raise rates. No, they're saying we've got to get inflation under control here in the United States, and we're going to go on longer than you think. It's like to hell with everybody else. Mm-hmm. So that's another shift that investors have to understand.
Grant, do you think that we have yet to see the real damage of the most aggressive rate hiking cycle to date in the US? As debt starts to roll over, for example, on the balance sheet of companies and households, that we have yet to see the real effect of this course of action.
Yeah, that's a great point. And I think you're absolutely right. We haven't seen the bankruptcies that we will see if interest rates stay here and go higher. There are, I forget what the number is, it's an enormously high number of zombie companies in the United States alone that just need to be able to roll over their debt at affordable levels and won't be able to. So that's still to play out. That will probably come with the recession that the Fed seems desperate almost to generate. Again, mm-hmm. I suspect believing that they can create just the right kind of recession that just kills demand and doesn't do any real damage, and then they can ride in and save the day. The hubris of these people is remarkable to me. And I tweeted out yesterday, we have to just think for a second about how bad a job they must have done to need 4 75 basis point rate hikes in a row. Mm-hmm. That tells you all you need to know about what a terrible job they've done. And it wasn't that this caught them by surprise. Everybody's been talking about this for a long, long, long time. They figured they could keep this thing under control. Mm-hmm. They figured, here comes inflation, but it's transitory and we'll be able to head it off a little bit and then it'll come back down and we can manage it. No, you can't. And so I don't think they've learned the lesson. I think they believe that having supposedly been able to control the economy and the business cycle, they can now control the recession. They can make sure the recession is just the right kind to kill demand to a sufficient amount that everything gets back on an even keel. I think they're utterly delusional. And the point you make is absolutely right. We will see that play out in bankruptcies and unemployment the same way we do in all these recessions. And they will be charged with riding to the rescue yet again. And that's when all those other things we talked about earlier on will start to be put on the table as potential policy tools.
Mm-hmm. It's interesting to me to think about the example of Japan versus the US, right? Japan, for example, has had decades of almost no inflation. They can't generate the type of inflation that they even want. And yet the US now is fighting inflation, to your point. They think they can engineer this recession to get what they need, yet they don't have control of inflation. So why do you think that Japan has yet or hasn't really had any type of inflation? And do you think that going forward, maybe because of the energy costs, they're going to be seeing a lot more inflation at this point?
Yeah, we're already seeing it in Japan. I mean, there's a huge demographic deflationary impulse in Japan. The population is getting smaller every day. So they have that, which has been a huge tailwind of sorts for the Bank of Japan, in terms of allowing them to do what they've done without letting inflation get out of control. But again, energy is the problem. Japan imports all of its energy, particularly in the wake of Fukushima when they've shut down the nuclear power plants. So Japan is now at that point where we've got inflation in Japan starting to prick up. It's nowhere near what it is in the US and Europe, but the likelihood is it's going higher, not lower. And so Japan is going to be faced with exactly the same problem that the rest of them have had, maybe not to the same degree, but they're going to face the same problem. And for them, it's going to come as a huge shock because, in yen terms, prices in Japan are pretty much what they were 20 years ago. I mean, if they're different in other currencies. And look, if you think about Japan, I was talking to another friend of mine about this week. Japan's just opened back up, right? It's just opened back up. They're going to face the same problems that everyone else has faced with labor shortages. There's been no labor coming into Japan for a couple of years now. And at the same time, given what's happened to the yen, it's going to become one of the most popular tourist destinations in the world because everyone who has had a desire to go to Japan for the last 2 or 3 years hasn't been able to. And guess what? It's 2/3 the price it was. So, I think service inflation in Japan is going to go through the roof, and they are going to be faced with the same situation that everyone else has faced. And given the perilous state of their own central bank's balance sheet and the tools available to them, it's going to be interesting to see what they do. It's going to be interesting to see how they try and get out of this one, I suspect.
Mm-hmm. Yeah, it seems like they're just really backed into a corner at this point, and they're very likely not going to be able to, or the tools that they have aren't going to have the effect that they need them to, right?
No, and I think that's why we're seeing the yen do what it's doing. I mean, and we've seen the interventions they've made that, again, if you go back to the hubris of these guys, they probably figured, hey, we step in, we tell them we've got the bazooka, we're going to defend this line of the yen at 145, that'll stop it. No, not anymore. So what do you do at that point? If you're an all-powerful central bank, you've either got to put your tail between your legs and slink away and come back to fight another day, which they've done once. That didn't work either. We saw this with the RBA in Australia. We saw them abandon a peg on their 3-year note with egg on their face and the rates triple in the space of a couple of trading days. We saw the Bank of England do this back in '92 when they pulled out of the ERM and Soros broke the pound. It happens, right? It happens. Central banks are not all powerful. They do occasionally get outmuscled by markets, and everything they've done in the last 30, 40 years has been a tailwind for markets. Of course, markets haven't fought them. Why would you? If the central banks are going to continuously lower rates and buy bonds and do all the things that are good for the financial community, why would they bother picking a fight with that? Now they're trying to do things that run counter to the interests of the financial community, and there's money to be made on the other side of it. We're going to see a very different relationship between market practitioners, investors, and the central banks going forward, I think.
Mm-hmm. Grant, as you speak to many analysts, heads of hedge funds, experts of all sorts, what sense do you get from them about gold? Do a lot of them just think that it is maybe a yieldless relic of the past, or is it forgotten, really stable holder of value that will play a very important role in the shifting world of currencies going forward?
Yeah, it's an interesting question, and gold's always an interesting topic to talk about. Everybody has a view on gold, and those views don't change much over time. People either believe in gold as some kind of faith-based asset, or they think it's a ridiculous notion that a lump of metal could have a value ascribed to it. And I can understand both sides of that argument. However, when you think about gold and you look at what we're talking about, we're talking about one of two things. Are we talking about the price action of gold? Are people disappointed in the price action of gold? Well, the answer to that is simple. If the reason you are owning gold is for the price to go up, then yes, you're disappointed. Mm-hmm. If you want to own gold as a way to protect your purchasing power, then realistically, you should actually be quite delighted at what's happened to the gold price, right? Because you can see the threats to your purchasing power becoming ever larger, almost by the day now. And yet this asset that will protect you from that is getting cheaper. And we saw this we've seen this in the world of vol. We've seen vol get cheaper and cheaper and cheaper. And everyone go, well, the world's getting crazy, vol's getting cheaper, and more people selling vol because it's never going to go up. And then bang, you get explosions in vol. You get the move index trading at standard deviations that Harley Bassman, who invented the move index, said, with the move index trading here, it means central banks have lost control of the bond market. So look, I look at gold as an asset that protects purchasing power. So to me, I don't have a problem at all with the price of gold doing what it's doing. For me, it's a cheaper insurance policy for me than it was last week, and I'm not worried it ever goes to zero. I'm not worried about, in times of stress, it performing as I don't know exactly how it will perform, but I have enough history on my side to look and weight the risk accordingly and say, I think there's a very high probability, certainly high enough probability for me, that it will perform as I need it to when push comes to shove. And when push comes to shove is not when people want to trade gold and want to buy a futures contract because they think the price is going to go up and they lock that price differential in. It's when yield curve control and capital controls and currency controls get put in place and people need to own gold, not have an interest in the price of gold, but you need some gold coins, you need gold bars, or you need some way of physically protecting your purchasing power from confiscation or from kind of the vagaries of central banks. So, it's a lifelong fascination of mine, and I'm always intrigued by how people look at it. But I think, as I said, the people who are disappointed in gold are the people who have bought it as a trade, essentially expecting the price to go up. I'm long gold at 1,600. I'm going to sell it when it gets to 2,500, and that day is going to be any day soon. No, we're back down to 1,600 again. What the hell's happened? So it's two different ways of looking at it. And if you're one of those people, I absolutely understand your frustration. I completely understand why you're scratching your head saying, why the hell isn't it higher? Because it should be, but it isn't. But say if you hold it for the other reasons, then it doesn't matter to you that it isn't.
Yeah, and it's interesting to see, coming back to that idea of central banks and how they treat it. We just saw in the third quarter, I think it was the most gold buying by central banks since the 1970s or something like that.
Yeah.
And again, to me that speaks to the idea that you want to be watching what the smart money is doing, and central banks hopefully are some of the smartest money out there, right? But I appreciate that framework that you really separate the two camps of owning gold.
Well, look, if gold doesn't perform in a time of currency controls and capital controls, then I would be worried. If it doesn't perform when my purchasing power is getting destroyed and people are telling me what I can and can't do with my money, then I'll be worried. But until then, it's as I say, it's an allocation to me that's there as a protection mechanism, and I don't lose any sleep over it whatsoever.
Mm-hmm. So considering, as you said, the history that gold has, if we contrast that with something like Bitcoin or cryptocurrencies, do you think that these alternatives to fiat currencies are going to come under threat when we start to see these market dislocations really take shape and take hold, when these currencies really start to, let's say, devalue and we get some of these capital controls come in?
Yeah, look, I've tried really hard to care as much about Bitcoin as a lot of people tell me I should. Mm-hmm. And I just can't. I just can't devote the time and the energy to it. And at some point, I may very much regret that. At the moment, I don't. And look, I've got a whole bunch of super smart friends who I respect tremendously who are big Bitcoin advocates. Mm-hmm. But look, to me, I think if we can agree that the end game here of sorts is a central bank digital currency, and there are all sorts of reasons why that makes all the sense in the world for policymakers to institute. on that alone, having competing digital currencies with a central digital currency is not something I see being allowed. And it's very simplistic for me, but that's only because I don't spend my life immersed in the Bitcoin world trying to understand it. As my friend Tony Deeden said so perfectly, it's just not suitable for me, and that's how I feel about it. But if you control the on-ramps and the off-ramps between cryptocurrencies and fiat currency, it's kind of all you really have to do. And so, look, I'm the worst person in the world to talk about it. I understand the reasons for it. I understand the philosophical argument for it, and I absolutely agree with that 100%. I think it's become much more about the price of Bitcoin, as it became about the price of gold, and not necessarily the value of Bitcoin. The value is subjective, and it's still to be proven over multiple cycles. It's become all about the price, and for me, I just don't care about it enough, and I feel bad saying that, but it's the truth. I'm not going to lie to you and pretend I know a lot about Bitcoin. I'm going to tell you that I've looked at it and I understand what it's about, and I sympathize. I just can't find a way to care about it enough, I'm afraid.
But kind of getting back to that idea of, let's say, as a threat to central banks, do you think that gold and Bitcoin could come under some type of control at that point?
Well, look, we have a precedent with gold, right? We have a precedent with gold being banned in the United States by Executive Order 6102 in 1933. That was done, so we know it can happen. And anyone that says it can't happen again is out of their minds. I think gold and Bitcoin offer a very different threat to fiat currency or official currency, whatever you want to call it. Your cryptocurrencies allow you to move massive amounts of wealth around the world anonymously. And gold, while it does that, there is that physical component to it that doesn't make it quite as easy to move $100 million with the click of a mouse. So I think if we get to that world of repression and currency controls, then I think cryptocurrency offers a bigger threat than gold does, simply because the majority of gold owners in the world are small. I mean, most of them are in Asia and they own a few gold coins, and that's not really something governments are going to want to go after. They might put caps on how much gold you can own. We don't know, but it's absolutely not beyond the realms of possibility. But the ease, one would imagine, of stopping crypto is easier than that of gold. If you, I think with anything, if you make it illegal to own, most people will sell it because they don't want to break the law. The same probably goes for gold, except that for that to be the case, you would need to make it illegal in places like India. Good luck with that. In places like Vietnam, good luck with that. Making gold illegal in countries like that, it's just not going to happen. It just won't work. So, look, there's absolutely no way gold is completely safe from this idea of confiscation. But if I owned Bitcoin and I owned some gold coins, in a sock drawer, I'd probably be more worried about them coming for my Bitcoin before they came for my gold, because I just think it'll be simpler to create problems for Bitcoin, and Bitcoin will be in direct competition with a central bank digital currency, which gold won't be.
Interesting. Grant, having traveled quite a bit recently, did you get a sense of that maybe the rest of the world is slowing economically, or is it business as usual and everyone is just really wanting to get back out after COVID?
Well, I think there's two parts to that, right? That question. There's the business component and there's the personal side of it. And I think you've got this strange dichotomy where you go, restaurants are full, bars are buzzing, people are out spending money, and prices are going up, and people are still out spending money. But I've remarked in a couple of airports recently how there's no one in the shops at the airport, right? You walk through all these high-end stores. I walked through the airport in Rome a couple of months ago, and there was nobody in Balenciaga and Armani and all these high-end stores. There was nobody in them, and the airport was busy. And I walked past store after store after store, and no one was in there, which I find interesting. And also, being in town, seeing people shopping. No, people are out eating and drinking, but they don't seem to be shopping. And you could say that that's because they're ordering everything at home now, which I buy, but I don't think they're ordering everything at home. So I think we're in that place where people are starting to cut back, but after being locked up, people aren't cutting back first on entertainment. They're cutting back first on purchases. And so, again, there's a lag with this. So we're not going to see the real effects of this, I don't think, for a little while yet. But I definitely get the sense that people are kind of reshaping how they spend and reordering the priorities of the things they want to spend money on and save money on.
Mm-hmm. Well, Grant, I think that's a pretty good place to kind of wrap up today's conversation. Is there anything else on your mind that you'd like to mention to our audience?
Oh, look, I think we've covered it all pretty well, Tom, in this conversation. I just can't stress enough how different the world we live in today is to the world we lived in a year ago. Mm-hmm. And this idea of transitory, this idea of buy the dip, this idea that we're going to go back to the way it was, we just got to get through this little period, it may be right, but I think there's a very high probability that that's completely wrong. And so being lazy and relying on the world to be the way it was, I think is a critical mistake to make. I don't think the world is going back to the way we've known it for the last 30 or 40 years. And so what the new world looks like, we don't know, but it's taking shape in front of us right now. And you need to be alive to that fact, and you need to be watching and paying attention, because things that you once thought impossible will become not only possible, but probable. And that's going to change the way you think about an awful lot of things in your life. So be proactive in your thinking.
Absolutely. And I want to thank you so much for, being generous with your time today and really sharing that framework with us. Of course, for anybody that would like to check out more of your work, you're available on Twitter at TTMYGH, things that make you go, and grant-williams.com.
That's it. Nice and simple.
Perfect. Thanks so much for your time today, Grant.
Tom, you're welcome. Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.